Hi, welcome to Money Confidence. I'm Crystal Oculee, the Chief Financial Strategist here at Confidence Wealth, and every week I try to bring a topic to you that seems to be the talk of the week. So lots of conversion conversation, Roth conversions. So if you've been thinking about Roth conversions or you've been doing them, it really is important to understand that Roth conversions, yes, it's all about tax planning, right? We want a tax plan not just for now, but for the future. So most of us that do conversions along the way is because we believe taxes are going to go up in the future. So we want to make sure we have money that's tax-free, that one, we can utilize in the future years, or two, we want to make our state more tax efficient for our heirs. So those things are really important. But what's also really important when it comes to conversions is what are you actually also converting? I have seen many people where they look at the dollar amount. An example, they'll convert a money market account they have, or they'll convert a fixed income account that they have. Well, think about it. If we're looking for our Roth money to be growing and we don't want to utilize that until the future, then it makes a lot more sense to be converting the equity side, the part that's going to be more aggressive and is going to have more aggressive growth. This is, again, the biggest reasons why tax planning and investment planning are intertwined together. It's the reason why we help our clients do this is because a lot of times the individual or the CPA doesn't think about that aspect. They only think about a dollar amount. For us, it's a little bit more than that. So yes, there's the dollar amount, but then there is which investments makes the most sense to convert. Imagine if you're holding technology that's been hit. And now let's say you're holding Apple and Apple has been hit and it's lower than where it was. Well, wouldn't that be the great year to actually convert Apple to a Roth? So that way you can allow that to grow because you were not planning on selling that to begin with. So these are the things to always think about. You may have some stocks that you've been holding for a very long time and you really like those stocks and you look at, okay, what the return has been. Have they been doing very well? Has it been volatile, but has the long-term result been always good? So those are the things that it comes into play when you're looking at Roth conversions. It's not just the dollar amount, it's also what type of investment you are converting. It also matters when you're looking to utilize them. I have too many people say, well, I'm going to convert anyway, and if I need the money, I can always touch the principal. Well, yes, that's true, but you kind of defeat the purpose when you do that. So what was the purpose behind it? The entire purpose of the conversion is that it's growing tax-free in the future. If you paid the taxes on it and then you turn around and utilizing it 2 years later, what was the point? So you have to be really careful and make sure that anytime you're doing a Roth conversion, it fits within the plan, it makes sense, and you're converting the right instruments. Now, it's also important to keep in mind it's not about converting every single thing. That's not going to be realistic for a lot of people. Now, for some people, they end up converting so much, forgetting that, there's a dollar amount that actually could be okay to still have in pre-tax dollars when they hit 73 or 75 when the RMD comes due. And, let's say they only had Social Security as income and now they are going to get required minimum distribution, where if they had 500,000 at that age still left in pre-tax dollars, the standard deduction offsets the actual RMD that they're taking out. So they're now not having to pay any taxes. So they put the money in tax, without paying taxes, and they're taking the money out without ever paying any taxes on it. So again, that's also important. Everyone's situation is totally different. So what works with one family doesn't work with for the other one because of what's going on with the rest of the income. So it's not a blanket statement that you should be looking at Roth conversion. It's not a blanket amount that everybody should be doing. It's very specific and unique to each individual family and their income and the goals in the future. So if you've never done what I call advanced Roth planning, that's where you want to really make sure that, if you're working with us, reach out to your team. We're already doing that on a regular basis. But if you wanted to have, a separate meeting to discuss all of that, even if it's things you're doing in the future, it's really important to do that. If you are friends or family of our clients and you've never looked at this, or your advisor or CPA have never talked to you about it, this is why it's really important to do that. It's not just do this amount and that's it. It's about what specifically you're doing, which instrument, the goal for it, and the cost that you have to pay now versus the reward you're going to get in the future, and weighing out the difference and then going for it. Until next week. And if you have any questions, please don't hesitate to post or email me directly at askcrystal@icwm.com.